Hey guys, welcome to another episode with me, Shashank Udupa. And in this episode, we're going to talk about something that most of us have an issue with, and that is how to read a quarterly report or how to read these, financial reports that companies keep coming out with. Now, we know that this is quarter seasons, right? Quarterly results season where a lot of people are coming out with their results. Many companies have already come out with their results. Most of the companies are still left to come out with their results. So, wo aayega abhi thoda din mein, it'll come in a few days. And most of these stocks you might own as well. Now, it is very important for an investor to understand the stocks that they're owning and to see the performance of the company quarter on quarter. For that, you should know exactly how to read a quarterly report. And a lot of people just look at the net profit, but that is not what it means. There are so many things for you to look at in a quarterly report to understand the health of a company that you have invested in so that you safeguard yourself in the future. So in this episode, I'm going to teach you how to read a quarterly report thoroughly. I'm going to tell you some different points that are required to look at in a quarterly result. After that, that there are different type of industries in India. There are different type of sectors, and each of them have different type of reporting standards as well. So we're going to look at in another segment, we're going to look at the different type of sectors that are there and how their quarterly results are different from other companies and how you can read them and how to understand this. So this is going to be a value-packed episode. And you need to learn this so that this is going to be a lifelong learning for you if you know how to read a good quarterly report. So in the next segment, I'm going to look at I'm going to tell you what to actually look at in these quarterly reports. Okay. See you in the next segment. Now, the first thing that we're going to look at in a quarterly report, as soon as you open a quarterly report and you go to the profit and loss statement, the first thing that you need to look at is something known as a top line growth. Now, what is top line growth? Top line growth basically means is the company's revenue or sales growing quarter on quarter or year on year. That is why it is called top line growth, because the first thing that you see in a profit and loss report is sales or revenue from operations. So that is what you see on top. So that is why it's called the top line. Now, why is top line growth so important? Because the company that you're investing your hard-earned money into, it needs to grow year on year, quarter on quarter. Growth hona chahiye. It has to keep growing. If it doesn't grow, that means it's going to be an issue, because then your share price will not grow if the company is not growing. So you need to see whether the sales of a company is growing quarter on quarter or year on year, and that comes with the top line growth. So top line growth is very important. Now, there's two things to look at in a top line growth. Okay, now how can a top line grow? Either me as a company starts getting more clients. Okay, so I do more sales. And if I do more sales, obviously it comes in a top line growth. Obviously my revenues will be more. Or the second option is I have not increased any of my clients. My clients are still the same, but I have increased my pricing for each of the client. Okay, so that becomes a price growth. It is not a volume growth, but it is a price growth. So there are two things to look at. If a company has grown, has it added new people has it added new clients, or is it expanding its base, or is it the same base and it's just expanded its pricing? So these are two things you need to look at when it comes to top line growth. Now, the second thing that we will look at is something known as profit growth. And this is almost like the bottom line. This is profit growth. Now, when it comes to quarterly results, net profits, okay, or net profit after tax as they call it, or they even call it profit after tax. You will see it as PAT, okay. Now, these two things are very important when it comes to quarterly results. Net profit after tax, after everything, is super important because that determines the movement of your share price. Now, top line growth is great, but imagine I've grown my top line a lot, it's grown by 10%, but my expenses have grown by 30%, then in the end, when it comes all the way down after cutting my expenses, the profit will be very less. And profit is the most important thing in a business, correct? Now, if the profit is low, then the share price will not move because everything depends on the profit. And there is another key term linked to profit, which is also known as EPS, which is earnings per share, which is used to calculate how your share price has to be moved and whether it is undervalued or overvalued. So everything depends on net profit. Now, there's another thing also. Sometimes we see this thing in the market, and you guys must have seen it very recently, that the company comes out and delivers amazing result and the share price goes down by 4-5%. And you're like, result was good, but why did the share price go down? I'm so confused. The reason why this is the case is because there is in the industry, there is something known as investor or analyst estimates. Okay, so all these analysts from different financial institutions look at a company and say, you know what, this particular company needs to go up by 10% and the revenue has to be approximately so much is what we're predicting. Now, if the company finally results come out, but the revenue is not the same as what the analyst of the entire industry predicted, then the share price is a disappointment and everything goes down again. This is why we see that in some companies they give out an amazing result, but misses street estimates, you'll see a news and the share price goes down. What I would say is it's okay, it's completely fine. If a company is giving good fundamentals, if a company is giving good top line growth, good bottom line growth, your earnings per share is increasing, then you should not be worried, because we are here for the long term and we always do long term investing as opposed to short term investing. Okay, so understand that. Now that is why profit growth is extremely important. Now the next thing that we will look at is something known as quality of earnings. Now what is quality of earnings? When we talk about quarter-on-quarter result, or sometimes when you even look at year-on-year result, it is very important to check in this earnings report that did the profits of this company rise or fall because of something else. Okay, so remember I spoke about volume and pricing in the first segment. What if the price of the entire price of the revenues has gone up because maybe the commodity that it is dealing with went up for some reason? And this we see a lot in commodity companies, right? Where you suddenly see a massive spike in the company's revenues, even though the company has not changed anything, but the commodity pricing went up by 10-20%, so automatically their pricing goes up by 10-20%. Now, you need to understand that is this a sustainable long-term rise or is this a short-term temporary spike? That is something you need to really understand. Because if you think that this is a short-term spike, you should not get too excited and invest more. Because if it's a short-term spike, then it will come down after the spike gets over. But if you think, no, this company has improved its manufacturing capabilities and this is a long-term thing where the volume is increasing and the price is also increasing, then I want to invest, that becomes an informed decision maker. Now, another thing for you to check in a quarterly report, you will see one small line called extraordinary items. Please have a look at that. Now, once you see how does a basic business work, you have profit in the top line, then you have expenses of your employees and all your manufacturing and production cost, everything is all the employee expenses are there. And then you have net profit, expenses before net profit and taxes and interest. So it's called earnings before interest, tax and depreciation, EBITDA it's called. Now after that you remove other stuff which are not directly related to the core business, which is your loan interest, the EMI type interest that you pay. Then you have to remove taxes, and over there is something known as extraordinary items. Now these are one-off items that come only for that quarter, and it is just an appropriation that happens. Sometimes you might have sold a particular plant or you write off something. It's an extraordinary thing that is only there for one time. But what happens here, if an extraordinary thing comes up there, okay, right before this, what happens is it shows that your profit is very big. Suddenly it shows your net profit is very big. You need to understand that this is only because of that extraordinary item, and ye ek hi baar hua hai, this is only come once. Next time this won't come. So again, don't get too excited about that and invest at that point. That would be a big mistake that you would do. Now we've understood what top line growth is. We understood what bottom line is, which is basically your net profit. We've understood what extraordinary items are. Now there's another important metric for you to understand, which is known as operating profit and operating profit margin. Now basically, what is operating profit? Operating profit is basically all your revenue that comes and your business related expenses is called operating profit. Any profit that has come before depreciation, before interest, before tax is considered as operating profit. Now operating profit basically tells you whether the business is running good and they can actually sustain their entire business with the revenues that they make and the expenses that they have to give out. Now operating profit margin basically is very simple. It basically means it's operating profit divided by your entire total revenue. So that is what it is. Now, if a company is showing good operating profit growth or good operating profit margin growth, that means the company is a good company giving good business practices, and it is improving constantly because the number of revenue would be growing, and that means the expenses is not growing as the same as revenue. So it is considered very good for the company. Now, the next thing you need to look at, okay, now this is a very common question that a lot of people ask. Do we compare year on year or do we compare quarter on quarter? What do we actually look at? Now, very important question, because a lot of stocks are seasonal. Okay, there's cyclical stocks, especially commodities, something like jewelry industry. They're completely seasonal, right? If you look at Diwali and if you look at wedding season, the sales will be high. But if you look at any other seasons, the sales will be low. So even though on a quarter basis, it might look a little weird, but on a yearly basis, you'll see the growth. So But for example, if you look at some other business like the telecom industry, where quarter on quarter growth is so important because it's always a big fight between 2 or 3 different companies in the telecom space. So what you need to look at is, first you need to understand what is this company. Is it a cyclic company where I need to look at year on year? Is it a commodity type company where I have to look at year on year? Or is it that kind of a company where the competition is so high that I have to look at quarter on quarter growth? So that depends completely on the industry, and that completely depends on the company that you have invested in. Now, the next thing which is very important is something known as guidance. Now, what is guidance? Now, some companies, basically guidance is, the company comes and gives the results out. And after they give the results out, the company gives a guidance or maybe a strategy of what is going to happen in the next quarter or in the coming year as well. Now, some companies give forward-looking guidance, means I'm going to tell you now, this is the report right now, this is the result right now. In the next 3 months, we plan to grow by another 4, 5, 6%. That is what some people say. But there are other companies like, for example, TCS, that till date will never give you a forward guidance. They will never tell you what they're going to do in the future. They're like, you wait and we will show you what we can do. Most of the companies who deliver these quarterly results, they come out and talk about their future plans. Why? Because it is very important for the company and shareholder to talk to each other, and the company has to explain what are the plans for it going forward. So that is why it is very important for them. Now, you need to look at guidance very closely. Okay, don't take it as the whole truth, because if a founder of a company comes and says next quarter we will grow by 50%, doesn't mean you believe it and just invest all your money. Don't do that. It is only to understand what strategy this guy is trying to do, what strategy this company is trying to employ, and will it work or will it not work. Ideally, it is good to understand the previous guidance that the company has given and see if he's followed this guidance, because a lot of times you can predict something but it might not go your way. So you need to look at it from that perspective and see that, okay, you know what, even though the company founder is saying it might grow by 20%, I'm going to be realistic about it and I'm going to see whether it's good or bad. That's what you need to do. Another thing that you need to look at when company's quarterly results comes out is something known as management interviews or con calls. And this is so important. I can't tell you how important this is. So every time after the company gives its result out, they might give you a dividend or a bonus. And after that, they schedule something known as a conference call. Conference call basically means the management is doing like a press release, like a press call, where there are people from the financial industry asking questions to the founder, and more importantly, asking questions about the quarterly report. And you will get a lot of feedback about the future plans of the company, right? Where I've sat on so many con calls where they say that this year, we're going to spend so much crores, so and so crores on capital expansion. We're going to put it on capital expenditure, expand with more manufacturing plants. All this cannot be said in the profit and loss account. So you need to listen to the founder as well. So that is why management interviews is very, very important for you to read. Now, another thing that is very important when quarterly result comes out, when the quarterly result comes out, they also do something known as shareholding pattern for that quarter. Now, why is shareholding pattern important? Why? Because I want to see if the founders still have the shares or not. If a promoter or a founder is slowly selling off his shares, that means he also doesn't have so much, conviction in the business that it might do well. If the business is going to do well, the promoters you will usually see buying more shares of the company, which is considered a good sign. But if the company's promoter is selling the shares, then why will I be so motivated to keep it if you're selling the shares? Now, that is important. Another thing to look at in the shareholding pattern is something known as pledging. Okay, so a lot of founders pledge their shares, and too much pledging of shares is also not a very good thing. So that is also something you need to look at. Now, the last thing you need to look at when the quarterly result comes out, there are some companies that issue segment-wise revenue breakup and geographical-wise revenue breakup. Segment-wise means in their business, they might have 3 or 4 different segments, and what is the revenue from each of the segments. Now, why is that important? Because I want to see whether the segment breakup is growing or not growing, and what is not growing. If something is growing constantly and suddenly I see a dip in one segment and a growth in another segment, I can start connecting the dots for the future as well. Now, the same thing comes with the geographical breakup. If I have a company that has invested or is getting revenues, 90% of revenues from USA, then I know if something happens bad in USA tomorrow, then this company will definitely have a big issue. And too much distribution onto one thing, if they don't diversify their portfolio, if they have too many big clients with giving most of their revenues, that is something which is a big risk for you when you're investing in the stock market. So these are the different number of points for you to look at when it comes to quarterly results, understanding them. And what I'm going to do now in the next segment to make it more easier with more examples, I'm going to talk about industry specific quarterly results, because I know for a fact there are different industries with different reporting standards. So let's look at what are the key metrics to look at in different industry segments. Now, the first industry that we will look at are banks. Okay, now banks have different type of operations and top line when it comes to their different type of terms that they have. And let's look at what these terms are. If you look at their top lines, they have revenue from operations, but the revenue is in a very different way. So let's look at this. Now, the first thing that you need to look at for a bank is something known as NII, or net interest income. Now, what is net interest income? It is basically the difference between the bank lending money to a lot of people at a particular interest rate and the bank giving people money when you keep your money in FDs or savings account. So how does the bank make money? The bank only makes money by lending the money to other people and taking a higher interest rate. So if the savings deposit, if the bank has to pay everyone in a savings deposit 6%, and if the bank is giving loan to people at an average of 12%, then the bank makes 6% profit. That's how it works. Now, obviously, an increasing NII trend will be better, because if the bank gives loan for a higher interest rate and has to give less deposits, less interest for the savings deposit holders, the bank will eventually start making more money, and on volume that would be even more. So an increasing NII trend is considered a good thing. Now, another thing to look at in banks is something known as NPA, and this is something that we've heard about a lot. What is NPA? NPA means non-performing asset. Okay, now there's two things in NPA. There's gross NPA, you will see right at the bottom in a quarterly report. It is GNPA, and you will see NNPA. Two things. Now let's understand what they are. Now, a gross NPA is basically a loan or an advance that the bank had given to someone. Okay, and the principal or the interest payment has not happened for more than 90 days. Okay, they've given a loan to someone and he's not paid back for the next 90 days. As soon as that happens, that person or that entity falls under, or that loan falls under GNPA, which is gross NPA. It's not fully gone, but it is considered as a bad loan. Now, what is net NPA? Now, as soon as you understand that, okay, this is a bad loan, the bank has to keep a provision aside. They have to keep some kind of money aside for all these bad loans. And that is a portion of money that they keep from their own profits just to accommodate the bad loans, are known as NPA. Again, a decrease in net NPA. A decreasing trend is good for both GNPA and NNPA. So any bank that has a low GNPA and NNPA, it is considered a good sign. There are banks that have very high NNPA and GNPA, that's considered a bad sign. Now, another very important metric is there, and that is known as capital adequacy ratio, or CAR. Okay, CAR, capital adequacy ratio. Now, what is that? Capital adequacy ratio is basically a bank's capital in relation to the risk of its weighted assets. Now, to make it more simple, what is risk-weighted assets? They're basically a total assets of a bank with relation to the weight of the risk that they currently have. Now, you'll be like, Shashank, how to calculate this risk? What is this risk that you're talking about? Now, let me give you an example. You and me both know that unsecured loans, okay, with no guarantee and no asset attached to it, unsecured loans are more risky than secured loans, okay, which in turn would be more riskier than keeping cash in hand or government securities. So obviously unsecured loan is very risky, so that is the weight. And if if they have a lot of collateral based loans, it is considered a good thing. Now what happens is, if this ratio, it all depends on this ratio, provision amount is kept on this ratio. The ratio indicates basically how much capital a bank must keep aside in reserve in order to reduce the risk of the bank completely going bankrupt or completely becoming insolvent. So the bank has to keep a separate. So that is why it is very important that the bank gives out loan to good people, because if they give it out to bad people, they have to accommodate all this in a reserve pool so that they don't go bankrupt tomorrow. So this is how banking companies work. Now, the next thing, let's look at insurance companies. Now, insurance companies also, they're slightly different because they don't work on income. They work on something known as premiums. So there are two things to look at when it comes to insurance companies. Everything else is the same, but the two different things are known as gross premium and net premium. Now, policy holders will basically pay premiums to cover the insurance bought for them for any kind of financial loss. I'm buying an insurance and I'm paying a premium for it. The gross premium is the total premium paid by the policy owner to the insurance company. Now, what is net premium? Net premium is basically referred to as the income earned by the insurance company after cutting and excluding all the expenses. Basically, their final income, what they would do is something known as net premium. So these are the two things that you need to look at when it comes to an insurance-based company. Next, let's look at IT. Okay, information technology. Let's look at IT. Now, what are the important things to look at in an IT company? You need to first look at new clients added in a particular quarter. For that, you need to look at the news very closely, because if you look at all these big companies, IT firms, they keep adding new clients and they keep releasing press statements for the new clients. So this trend should be increasing, number one. The third thing, which is the most important thing, is utilization. Now, let's understand what utilization is. In an IT company, the biggest resource for an IT company are people. That is why they hire so many so many employee workforce is there in an IT company. It's basically you get a project and you assign people to that project. Sometimes when the projects are less, but you have so many people, these people are usually benched. They're not utilized to their maximum capacity. Imagine you have 100 projects and you have only like 10,000 people. Obviously, there'll be some gap over there. So these people are known as benched people. But if the benched people are less compared to the number of people on the workforce and actually working hard, that means the revenue for the utilization for this company of employees is high. That means the revenue potential also increases. So the utilization of this company should be good, because if more people are sitting idle, you won't make a lot of money. But if more people are working, you will make a lot of money. That is how IT industry works. Now, the next industry that we will look at is infrastructure. Now, infrastructure is quite simple. There's only two things to look at, very important. One is the order book or the order inflows, because every time the infrastructure company has to bag these big government orders or big projects that they have to keep bagging. And bagging basically means, they get this order. And that is something that again comes in the news. So you need to keep a track of, if you're in an infra company invested there, you need to keep a track of the new orders that are being secured by this company. And usually you see a price movement when they get a new order. But second most important thing, which is very crucial, is something known as debt to equity ratio, DE ratio. Now, you know that in infrastructure companies, if to fulfill a particular demand, they have to first take up a lot of loan, because it is very capital intensive. You need to have a lot of capital to first build, say, a flyover or something like that, and then you get revenues over time through toll. So one must keep a track of how the debt to equity ratio looks like. So please keep an eye out on how debt to equity ratio works. Now, the next thing we will look at another industry, which is the telecommunication industry. Okay, and there are only a few players in the telecom industry right now, but here there are two major things to look at apart from their revenue, and that is ARPU, the first one, which is known as average revenue per user. Average revenue per user, basically, as the term suggests, it is an important indicator because it talks about how much revenue the company is making on an average per user. So if I'm a user of, say, a particular company, what is the revenue of me plus you plus all the top subscriber base, and they put an average to it. So that basically comes up with the total revenue they make and the number of users they have. Now, an increasing trend is obviously considered good because they're making more money out of it. Now, the second thing that you need to look at is obviously the total subscriber base, right? A company needs to have more people on their telecom service. Obviously, they'll make more money with the average revenue per user growing. So ideally, it should be a mix of two, because the volume should be there from the number of total subscriber base, and your ARPU should be good. And if both of them are increasing, that means the company is doing really well. It's no point having a good ARPU but no consumers using your platform. So that is something that would be slightly sad. So that's how you look at telecommunication industry. Now, the last thing that we would look at is the pharmaceutical industry. Now, there are some things in the pharmaceutical industry, and we did this in the episode where we spoke about the pharmaceutical sector, and that is we need to track their NDA and ANDA. Now, we spoke about what NDAs and ANDAs are. NDA is basically something that you need to file with the FDA, okay, where you have 4 phases of clinical trials, and then you have to file it with the FDA. A new drug application, it is called, and it is a complete document that talks about all the 4 stages of clinical trials that you do, and you must request approval from the Food and Drug Administration in US, which is the FDA, to issue and market a new drug. The cost and price of this drug is obviously more compared to an ANDA, and if you know what ANDA is, it is abbreviated new drug application, and this is mostly in the generic drug segment, which we spoke about all this in the pharmaceutical video. You can go check that out after this. And that is basically to review a generic drug again given to the FDA. Now, after approvals, both these drugs start getting approved, and then they come into the market, and then they can start selling this out as well. So obviously for pharmaceutical companies, it's very important to track how many new drugs are coming out. Have they filed a lot of patents for NDAs, or have they filed a lot of approvals for ANDAs? And we need to look at how many ANDAs have they submitted, or how many NDAs that have submitted. Now, in ANDA also, it's important for you to understand that there are 4 types of filings made on an ANDA perspective to the FDA. The first para filing would be if the filing is made when there are no listed patents in the market. Okay, number 1. Number 2, if a listed patent is expired right now. Okay, so if it just is expired, then I can file an ANDA for that. The third would be that the expiry date is coming close. The patent will expire on a particular date. That's para number 3. And para number 4 is the patent is invalid or cannot be infringed by this drug. So when people file ANDA, you can check out what is happening basically in this. All this tells us how the product pipeline of a pharmaceutical company works. So this is basically how pharmaceutical industry works as well. Okay, finally coming to the conclusion. I know it was value packed because we looked at how to read an quarterly report. We looked at how to read a quarterly report quite extensively. We looked at top line, bottom line, extraordinary items, management interview. It's not just that document that you read. You need to understand how to read profit and loss and balance sheet. You need to understand how to read management reports, management interviews. You need to read a lot of things with respect to, say, shareholding pattern and how they're pledging and not pledging. Then you have to keep track of all the companies in the stock market with respect to their new orders that they're getting, or if they're talking about some new clients that they're getting. So you see, so many things are important for you to understand when the quarterly result comes out, or this earnings season that they call it, because that will determine whether you keep a particular share for a long period of time. And it is always beneficial to be a knowledgeable investor than just being a random investor, not with zero knowledge investing in the stock market. So as I always say, you need to gain as much knowledge as possible before investing. So I hope this episode or this video gave you some knowledge when it comes to quarterly result. And if you like this episode, please like, share, subscribe, and comment below. And yeah, I will see you soon, and I'll keep coming and dropping such value bombs. So this is Shashank Udupa signing off. I'll see you soon. So guys, just a disclaimer, everything that is shown in this video is only for educational purposes. If any stocks or any funds have been mentioned in this video, it is not a recommendation from our end. This entire video has been done only for educational purposes.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.